Welcome to my web training on how to earn 16% internal rate of return without fixing toilets or managing contractors while taking advantage of loopholes to create wealth. If you're an accredited investor and you know there is more out there for you, techniques, ways to sharpen your tools to get you to your goals faster, tune in and let's have some fun. My goal is to give you practical applications over the next 20 to 30 minutes that will show you how to leverage loopholes available to you that other investors take advantage of every day. This is a picture of myself and my brother Austin, who is also my business partner on the road a few years back scouting out properties out of state. I'm assuming if you're watching this, you have some business sense, which means you know there is always another level you can get to. To get to the new levels, you have to learn. You can either learn from others or go make the mistakes yourself. We are here to give you a few tools that will help you go faster. As The Rock says, we're all in the same game, just different levels. Dealing with the same hell, just different devils. So, we will share some complexities that come with the next levels and how to best deal with them. I don't want to beat a dead horse and recite back to you what you learned in Robert Kiyosaki's book, but I will note, I know everyone is in real estate for a specific reason. Whether it is to create financial freedom, create time freedom to spend with family, pick up or start hobbies, start businesses, or volunteer, whatever it may be for you, good on you, and we are here to help you do it faster. Don't worry, we're not going to tell you to go out and spend your money on advertisement campaigns or how to negotiate with sellers to get better terms on a deal or fly to a property to perform physical inspection. As you know, the operators do all that for you. We are here to help you tweak a few things, show you the light at a different angle, and hopefully you can pick up something today to apply to your business. In this training today, you'll discover a loophole that makes investors wealthy through passively investing in real estate and how to handle the complexity it creates. Two myths that successful, smart, and wealthy investors have debunked and how you can implement the learnings today to increase your return on investment and reach your goals faster. How our team member Pat allows us to analyze properties in volume in little time and present more quality opportunities to our investors. One of our investor partners, Garrison, has invested in multiple deals with Austin and I. He had cash, took action, and now it's paid off for him. Here's a quick blurb from Garrison, sharing his experience in working with us.
I'm Garrison Van Dyne, a real estate agent, broker, and investor with about 10 years in the industry. I personally have experience actively investing through fix and flips, long-term holds, as well as the BRRRR method. I've been working with small amount investments for about 2 years now and continue to do so because they give me good returns for very little effort. I know that once I syndicate a deal with them, I'll get a paycheck in my mailbox every month, whether or not I'm actually doing any work. I no longer have to worry about finding deals, managing rehab, placing tenants, or refinancing/selling the deals. Once I sign off on a deal, I know that my part's done and they'll take care of everything from there.
A few investors have asked me lately if we are 1031 exchange friendly when we run syndications for large multifamily projects. Let's outline what it means to be 1031 exchange friendly, the benefits of this for our investors, and the complexity it adds to the structure of a deal, why a lot of syndicators don't offer it. If you're considering a syndication as your next investment, to park 1031 exchange money, make sure the syndicators offer 1031 exchanges to their investors. P.S. We are 1031 exchange friendly. As you probably know, 1031 exchanges allow investors to take a profit from appreciation and buy another similar real estate asset of equal or greater value with the profits from the original asset. This allows tax on the gains to be deferred. That's huge. Think about it. If you're taxed at 20 to 50% every time you cash out, wouldn't it make sense to try to build as many gains tax deferred as possible? In order to qualify, the investor needs to identify up to 3 properties of equal or greater value within 45 days and purchase it within 180 days from the sale of the original property. The investor needs to use a qualified intermediary. The investor never touches the cash from the sale, or the entire 1031 exchange is null and taxes will need to be paid for that year. If the investor sold the property with $100,000 in equity, but they still had $100,000 of debt on the property when they sold it, they need to take on the $100,000 in debt on the new deal in order to meet the 1031 exchange requirements. The investor needs to inform the syndicator they require $100,000 of debt in the deal. In a traditional syndication, 70 to 80% of the deal will be bank financed. Let's say, for example, the purchase price is $10 million and the bank is requiring 25% down, or $2.5 million, and they're issuing $7.5 million in debt. In order to get the 1031 exchange done, the investor needs to take on and sign a promissory note with the bank stating they are responsible for $100,000. There is complexity to this, but as long as you plan for it, it's well worth it in our opinion, and that's why we offer it to our investors. Myth number 1: retirement accounts are for stocks, mutual funds, ETF, options, and bonds only. Did you know that you can invest in an actual asset, like an apartment building or rental property, in a solo 401k or self-directed IRA? If you're self-employed and don't have any employees who work more than 1,000 hours per year for you, you qualify for a solo 401k. If you don't own your own business or you do have employees, the best option is to open a self-directed IRA. The main advantage to a solo 401k is contribution limits. For 2022, you can contribute a whopping $61,000 and an extra $6,500 if you're over 50. For a self-directed IRA, it is only $6,000 annually or $7,000 if you're over 50. So, how do the logistics work if you want to invest into a syndication with retirement funds? Well, you open a self-directed retirement account with a custodian who allows real estate assets to be held. You fund the self-directed retirement account. You can transfer money from a former employer, traditional or non-Roth IRA, SEP IRA, simple IRA, or if you're eligible, you can make a contribution to the solo 401k or self-directed IRA. This is typically something you can get done in 5 to 10 business days. Step 3, invest your money into a real estate deal, which is easily done through your custodian. It's really that simple, folks. There are a few legal guidelines you must follow throughout this process because you're investing in a retirement account. Always happy to refer you to the custodians we recommend so you can discuss in more detail. In my opinion, self-directed retirement accounts for the win. Myth number 2: investments are risky in down markets or in high inflationary environments like the one we are currently experiencing. The consequence of believing this myth is you will sit on the sidelines and you will lose money to inflation when other investors are getting wealthy. Let it be known that in the last significant financial crisis and real estate crash in 08-09, rents didn't decrease enough for it to have a significant impact on multi-family real estate investors, and in some cities rose or remained the same. This is highlighted on the graph showing rents and home prices. You can still bring in above average cash flow and annualized returns, even in a down market, even in a high inflation environment. Hard assets and commodities are known to be the best asset classes during an environment like this, whereas paper assets tend to take a significant hit. You may ask, what happens if the market takes a significant dip while we hold an investment we plan to sell in 3 to 5 years? Worst case scenario, we hold on to the investment for a longer period of time. The cash flow will continue to be solid and come in on a monthly basis, and we'll be able to sell the asset once the market stabilizes. Meet my brother and co-owner of Small Mountain Investments, Austin Hill. Austin has an engineering background and built our third teammate, Pat, from scratch for our investors, also known as our property assessment tool. He's going to take you through a 123 unit seller finance deal we are currently in negotiations on.
Hi, this is Austin Hill. I am Ryan's older brother, and I wanted to introduce you to Pat. Pat is our property assessment tool, and Pat truly gives us a competitive advantage when we're analyzing real estate deals. Ryan comes from a finance background. I myself come from an engineering background. We have built Pat from scratch to make sure that we have truly the best tools to analyze these multifamily properties and get the best returns to our investors. So we wanted to take some time and just walk you through, Pat. We look at really these real estate deals as a puzzle. There's so many different pieces, and if they are organized in the correct way, there can be extremely great results. So I'm going to walk you through really the 3 different phases that Pat gives us a competitive advantage. 1, during the analysis phase. When we come in and analyze a deal, we get sent all kinds of deals. We're networking with brokers, talking directly with sellers. We're doing a lot in our markets to make sure that we see every deal that comes available. So we got to get in and out quickly so we can focus our time where it's needed. These gray cells here are where we need to enter data. And by just entering the data in these gray cells, we can quickly see, yes, this is the deal we want to spend more time on, or no, this does not fit our investment criteria. And that's a huge advantage because we're able to quickly hop in, hop out. Now, second phase where Pat is truly helpful is in the negotiation phase. In addition to our numbers-based background, Ryan and I also have a pretty good sales background. Very experienced. I've had about 8 years in corporate sales. Ryan's been doing about 6 years in high-level sales as well. So both of us have experience. And from our experiences, we've seen tremendous results having negotiations from a numbers-based, factual-driven conversation. And this is what Pat really allows us to do. When we're negotiating with sellers, we can look at all these numbers and we can have a story behind why these specific terms are very important to us. And we've seen that really be successful over the courses of our negotiation. So a few different just spots I'll share with you. Right here, 27% down is what we're going to be bringing on this deal. You don't see that very much. It's a very odd number. But on this specific deal and how these numbers are all shaken out, that is the sweet spot where it's optimized for the best returns for our investors. So it gives us a story when we're sharing with our investors or the sellers why we're going at 27% down. There's a very specific reason, and I could walk you through all the numbers, but I'm not gonna. I'm just gonna leave it at this. And really, I'm going to leave it there as far as the negotiation phase, but really having those factual, numbers-based negotiations has helped us out a lot. The third phase that it really helps us out is post-close. We've had our negotiation, and then we've been able to close on this deal. These numbers here are the current income and expenses. These numbers here are what we look to get to. So looking at this side on the left here, the current average rent is $727 per month. That is far below market average, which is $809. In addition, they have no ratio utility billing system. That is standard in this market. So $50 per month per tenant is what they're not getting right now. This is a value add property, and it really is what allows our investors to have a great IRR as well as current cash flow. So $73,000 a month is what we're going to be able to add through the RUB system. And then we're also going to be increasing the rent by about $80 a month. You need to gradually introduce that. So we have built that into our spreadsheet. Again, our goal is to model our deal and how we're going to be managing and negotiating as best as possible. So going to the management phase, we're saying we want the rents to be $809. We want the RUBs to be installed, but it's going to take 24 months to get there, and it's going to be at an 8% clip is what we're going to need to be increasing the rents at to get to that 809 figure. To account for that, we have different things. Vacancy is at 10%. That's not normal, but because we're increasing rent and adding a RUB system, it's going to be more vacancy. It's just the nature of the beast. And we have property management, boots on the ground who have those conversations. They're the professionals. We set the goals and what the metrics need to do, but we aren't the ones having the conversations. We let the pros be the pros. They do this day in, day out. We leave it to them. It's just very important to have a metrics-driven conversation with our property management and something that we can truly have deliverables on. And lastly, I'll bring you to the investor breakdown page. This is where we have the share this with our investors. We can certainly take a peek behind the curtains if they want, but often folks don't want to see all those numbers. So this is where we look and see, okay, we've talked with the brokers locally on a established property that we're going to be at the point where we have RUBS, we have market rent. 5.7 is the cap rate typically where we see a sale at. So we're able to run those numbers. It says at month 48, going back to our cash flow, we can look and see at month 48, dating back these previous 12 months, what's our net operating income? And then we're able to have that number at this specific cap rate we sell at, what is the value? And that's added into our IRR final conversation and calculation with our investors. So it's just a numbers-driven, factual conversation throughout the entire time, both with our investors, while we're negotiating, while we're managing the property. Pat, our property assessment tool, truly helps us out in all three of those phases.
How do we structure deals and how are our investors involved? Once we find a deal we like, get an offer accepted, perform a physical inspection, and fund 70% or 80% of the deal with a bank or seller financing. As an investor, you won't be involved in this part. We sign for the loan. Then on to the exciting part. We turn to our accredited investors to raise the rest, usually 20 to 30% of the deal, to bring the deal to the finish line. This usually goes very fast because we only present great deals. Each deal presents itself very differently, but always has the same underlying goal. The goal is to get our investor partners consistent preferred returns, equity in the deal to increase their payout when we refinance or sell the property, with no cap on the upside. What that means is some syndicators cap their investors' earnings after a certain point. We don't do that. Usually somewhere in the 3 to 5 year range is our sweet spot for deals like this. I think it's important for me to point out before diving into the next segment, not every real estate deal always goes smoothly, as you probably know. I'll quickly share a story about a deal that we did that has shaped how Austin and I make decisions on a daily basis. Decisions around numbers, processes, and partners in our business. When Austin and I first started out, we bought a duplex in Huntsville, Alabama. Got underquoted by a contractor who ultimately dragged us along for a few months. Took thousands of dollars from us and ended up walking. Never spoke to him again. We got another contractor in there who then quoted us 5 times the amount of the original contractor quote we received. After that, we decided to list the house. We sold it to another investor, and after calculating in holding costs, we ultimately lost a little under $1,000. If we weren't able to sell the property, it would have been a lot worse. Easily a situation where you can lose $30,000, $40,000, $50,000. What's cool about experiences like this, and the reason that I'm sharing it with you, is not because we are particularly proud, but what it taught us. We are able to take what we've learned and apply it to each deal we buy moving forward. We're always ultra conservative when running numbers and detail oriented, as you saw in Austin's presentation. As you know, knowledge compounds when you partner with the right team. We have partnered with experienced investors who have owned close to 2,000 doors at one time or another. Eleanor Roosevelt said, "Learn from the mistakes of others. You can't live long enough to make them all yourself." Austin and I are not perfect. We don't claim to be perfect and believe in brutal transparency to everyone we come across. You have 3 options. You can do nothing despite all that you've learned today and continue your course, totally fine. You can go do this on your own and learn through trial and error, probably takes some time and money, totally fine. You can accelerate your growth by partnering with us. If you are an accredited investor looking to create another source of passive income or add to your existing, please go ahead and book a call with our team so we can take a look at your specific situation to determine if our current investment opportunities are a fit for you. Really quick, these are the qualifications of who we can help. Those searching for safe ROIs, those with savings, retirement accounts, or other funds to invest, and those with 1031 exchanges or looking to create 1031 exchange opportunities. As Warren Buffett says, I will tell you how to become rich. Close the doors. Be fearful when others are greedy. Be greedy when others are fearful. Although we would love to work with everyone who has $50,000 in the bank, there are a few people who we cannot help. Number one, get rich quick investors who like the ups and downs of trading in the stock market or crypto. Number two, non accredited investors. And as a reminder, an accredited investor makes $200,000 a year or $300,000 a year with a spouse for at least 2 years, or at least $1 million in net worth individually or with a spouse. We are only looking for 8 more accredited investors to help fund our deals consistently. If you are seeing this now, so are other investors because we are running advertisements. We're going to shut this down as soon as we find our 8. Go ahead and reserve your spot by booking a call below. On this call, we'll dive into your specific situation to see if Austin and I are a good fit to help you meet your investment needs. And of course, get any questions you have about our operation answered. And then, if a good fit, we'll go ahead and present our current investment opportunities. Thanks for listening. Hope you learned something and look forward to talking to you soon.